So, have you ever been asked by a bank for assurance on your financials and just felt that little bit of dread thinking about the cost of a full audit? Well, if that's you, you're in exactly the right place. We're going to break down the financial statement review. It's a super powerful way to prove your numbers are solid without, breaking the bank.
All right, let's dive into a classic growing pain for any business. You've probably had that moment when someone important, a lender, maybe an investor, asks for proof that your financial statements are, well, legit. It's a great sign, it means you're growing, but man, can it be stressful. So this is the big challenge, right? You've got stakeholders, like a bank, or maybe even potential buyers, and they need to trust your numbers. But the thought of a full-blown, super expensive audit just feels like total overkill for where your business is at right now. So what do you do? Well, the good news is there's a solution that hits that perfect middle ground. It gives you the credibility you need, but at a fraction of the cost and the headache. It's called a financial statement review.
Okay, the key word to really lock onto here is plausible. A review isn't about checking every single transaction down to the last penny. Instead, a qualified accountant comes in and performs specific procedures to figure out if your financials as a whole are believable. This gives you what's called a moderate level of assurance, and we're about to get into exactly what that means.
And this analogy just illustrates the difference perfectly. Think about it this way. A review is like a real estate agent doing a quick walkthrough of a house. They're looking for obvious issues, making sure everything seems right on the surface. An audit, on the other hand, that's the full-on home inspection. They're in the attic, checking the wiring, testing the foundation, every little detail. One is all about plausibility, the other is about total verification.
Now this moderate assurance thing has a specific name that sounds kind of weird at first, but it's actually a really powerful concept. It's called negative assurance.
This is the actual wording you'll see in a review engagement report. You'll notice it doesn't say, yep, everything is 100% correct, which is what an audit tries to do. Instead, the accountant is basically saying, hey, based on our review, we didn't find any big problems that would make us question these numbers.
So here's the bottom line. It's not an ironclad guarantee, but, and this is a big but, it is a qualified professional putting their reputation on the line to say that after looking at your books, no major red flags jumped out. And that, right there, is the piece of paper that lets your bankers sleep at night without you having to pay for a forensic investigation of your business.
So how do they actually get there? How does an accountant decide if your financial story is plausible? Let's pull back the curtain on the actual process.
It really boils down to three key things. First up is inquiry, which just means they're going to ask you and your management a ton of questions to really understand the business. Then come the analytical procedures. This is where they're looking for weird stuff by comparing your current numbers to last year or to industry trends. And finally, there's discussion, where they sit down with you and go over everything they found.
You see, the whole process is focused on your internal evidence. They're looking at the information you provide and basically asking, does this all add up? Is the story these numbers are telling consistent and logical? It's all about making sure your financial narrative hangs together. Okay, so we've covered the what and the how. Now for the really practical part, the who. Which businesses and organizations are the ones who most often need to get a financial statement review?
Most of the time, the request comes from somebody else. For instance, your bank will often require one as part of a loan agreement. Or maybe it's written into a partnership agreement to keep things transparent. And if you're ever thinking about selling your business, oh yeah, a potential buyer will almost certainly want one as part of their due diligence.
You see this constantly with small and mid-sized businesses trying to meet their bank loan requirements. It also pops up in certain regulated industries like travel agencies or private colleges that have to report to the government. And it's really common for nonprofits and charities, especially once their revenues get over a certain threshold.
So here's the big takeaway I want you to have. Don't think of this as just some annoying compliance hoop you have to jump through. Instead, I want you to start thinking of it as a really powerful tool in your business's credibility toolkit. Because ultimately, that's what it's all about. That's the real value. A financial statement review adds this crucial layer of reliability and professionalism to your numbers. It shows the world that you're serious about financial accuracy, and that builds incredible trust with the very people who are essential for your company's growth.
So I'll leave you with this question to chew on. As your business grows and as those relationships with banks, partners, and investors become more and more important, is a review the right move to build the trust you're going to need for that next big step?